A lot of people have asked why I've shifted focus towards Airbnb and away from long-term rentals. I've scaled from 40 long-term rental properties down to 19 Airbnbs, and here's some of the reasons why I've made that shift. All right, so number one is the cash flow is literally 10 times higher in my experience. So long-term rentals, they might have netted me $100 or $200 per month over a long period of time after all of the expenses, and my Airbnbs are routinely bringing in $2,000 or more per month after everything is paid. And what that's provided me is the higher cash flow gives me more room to invest and handle repairs or, things that need taken care of without stressing because that bank account is still going up on a monthly basis. Second thing here is going to be better tax benefits. And a lot of people don't understand this or don't understand really how it can impact their situation. So Airbnb properties allow me to write off against other active income. You see, all real estate can come with write-offs, but the problem is when you have a long-term rental property, the IRS considers that to be passive income or a passive loss. And when you have Airbnb properties or short-term rentals, the IRS considers those to be active investments. Therefore, a loss can go against other active income. And the classification there is you need to have an average nightly stay of 7 nights or less, which Airbnb properties can hit no problem. But if you're renting to someone on a year-long basis, you're never going to qualify for that. All right, so all real estate can come with a loss. It's not very difficult to do that. But the question is, can you actually use that against the income that you're currently paying taxes on? And if it's a long-term rental property, the answer is likely no. The second thing is going to be the write-offs go off of the purchase price, meaning apples to apples, even if you could use your long-term rental write-offs, the amount of that write-off is going to be far greater on an Airbnb property because we can afford to pay more and just naturally we're paying more in a purchase price when we're buying an Airbnb. So if you have a $500,000 Airbnb versus a $150,000 rental property, naturally the write-off you're getting from those more expensive properties is going to move the needle more towards your overall taxes. All right, and for a high income earner, these tax benefits are going to be far more greater than really any other benefit from buying a short-term rental property. How my deals are working out right now is, let's say it takes $80,000 as the initial investment for the down payment, the design, and the furniture of a property. Tax benefits alone might give me $40,000 back the second I file my tax returns, meaning I just cut that initial investment in half. And again, no amount of cash flow is going to give you that much of your initial investment back that quickly. All right, next year is going to be a stronger cash-on-cash return and a faster payback period. And this is primarily because of the extra cash flow and the tax benefits that I'm getting on the Airbnb side. But just for simple math, let's say it takes $30,000 to get a property up and running on a long-term rental. And then that thing cash flows, $100 to $200 per month. Well, when you break that down, it's ultimately going to take me 15 to 30 years in order to recoup the initial investment that I put into the property, unless I, appreciate and sell it or, 1031 it into another investment. But just strictly cash on cash returns, 15 to 30 years versus an Airbnb property. Again, let's say I put $80,000 into getting it up and running. I get $40,000 of that back in year one just from tax benefits. And then I cash flow $2,000 a month for the remaining $40,000. Just ultimately a couple of years, I'm going to have my full initial investment back on that property there. When it comes to the dollars you're putting into the investment versus what you're getting out, that cash on cash return is far greater, which has allowed me to scale quicker on the Airbnb side. All right, next year is going to be flexibility to adjust pricing, or ultimately flexibility to control revenue. And what I mean by this is, when there is demand spikes or drop-offs, I can actually drop my pricing or increase my pricing in order to make sure I am maximizing the overall revenue on that property. Same thing with like overhauling and reinvesting into the place. With a lot of Airbnbs, if you put more money into the design and the furniture, and the amenities, you're going to be able to have a direct increase on the revenue that you're making. With long-term rental properties, there's really a cap that ultimately, you're going to hit with that rent. It's not necessarily going to get tenants to pay more if you overhaul the backyard or paint the walls a different color or add in certain amenities. It's just, you're not getting that, direct impact on the money that you're putting in. So, I can take a underperforming Airbnb, overhaul it, and get it in the top 10%. With a long-term rental property, that overhaul is not going to double or triple the rents that it's going to bring in. And ultimately, at the end of the day, having more control over my investments is something that I've appreciated on the Airbnb side versus the long-term rentals. Next year is going to be lower down payments. All right. So with a Airbnb property, a lot of times I've been able to buy with a 10% down vacation home loan. I've even got special contacts that'll go all the way down to 5% on these vacation home loans. And with long-term rental properties, every bank or lender is going to consider them investment properties. And a lot of times they're going to want 20 to 25% down. So that's ultimately a lot more capital on the down payment side that's going to be getting tied up on the property. After that, we've got stronger appreciation potential. So again, we mentioned this before, but a lot of times with Airbnbs, we are spending more money on the purchase price. And in the same market, let's say you've got a $500,000 property versus a $150,000 property. If that market is appreciating by 5% per year, 5% on 500,000 versus 150,000 is a lot more dollars when it comes to the appreciation that you're taking advantage of in that market. So over a long period of time, you're just naturally going to build more wealth due to that appreciation because the purchase prices are higher. To piggyback off of that, we've also got wealth building through the loan pay down. So again, regardless on the investment you pick, the tenant or the guest are going to be paying your mortgage for you. But let's say you own a property for 30 years and a tenant pays down your $150,000 loan versus a guest pays down your $500,000 loan. That's also going to compound into building more wealth for you because your mortgage payments are bigger, the principal of those mortgage payments are bigger, and every payment that is being made, you're owing less and less on that home, and the higher value asset is going to compound quicker. All right, next here we've got higher quality guests versus long-term tenants. And this is something that I did not think about really when I got into the business, but again, I appreciated afterwards is, in my experience, when I was buying long-term rental properties, I had to buy in either C-class or D-class neighborhoods because A-class and B-class, they would not even pencil on paper. And just naturally, let's say even if the C and D-class tenants, paid on time, they're just going to come with additional life issues and headaches, that made it more stressful to invest in those types of properties. I had tenants who were paying on time, but I was getting calls from code enforcement from the local city saying, hey, if you can't stop the domestic disputes, we're going to come and board up your property. So ultimately, yeah, the bills were getting paid, but, calls from code enforcement are never fun. And, that's just some of the stuff that you might be dealing with in those C-class, D-class neighborhoods. With the Airbnb guest on the flip side, especially if you are doing high quality deals and competing in the top 10% of the market, they're going to be people who are paying premiums to stay in that property. And naturally, they're just going to come with more respect and have, fewer issues, there at that home. All right. And then next year is going to be less deferred maintenance. So, again, if I've got maintenance problems at a property, my cleaners are in there 3 times a week. So I'm going to know about them, really right away. And an example of this is like, let's say a leaking faucet, right? If I have that in an Airbnb, either the guest is going to tell me or my cleaners are going to know about it. But if I have a long-term rental, I have literally had tenants who will just let those cabinets fall apart because it's leaking onto the wood underneath a sink before they're going to call me to come and fix it, within that property. So little deferred maintenance items, they get addressed right away. And a lot of times it's going to be cheaper to get those solved out of pocket because I am specifically looking for cleaners who can handle little maintenance tasks. And with them being in there every other day or every other 2 days, I might be able to ship a faucet to their house or to my Airbnb and they can swap it there during their next clean. No one needs to make an extra trip to that property. Versus even if I did know about them ahead of time or at the same time of heads up with the long-term rentals, I still need to pay my maintenance guy or a contractor to go over there, schedule it with the tenant and make a special trip just to fix that item. All right. And then lastly here, I can actually use the property. So with the Airbnbs, I've actually been able to vacation at those places. I'm actually flying my family out to my place in Arizona in like 5 days. I haven't been there in over a year. So I'm going to check things out and we're going to take a little vacation and, work on a little mini overhaul while I'm out there. But that's certainly an intangible, is that you can use those properties. And then specifically in my experience, another thing with this is I can also let other people use those properties. And what I've done is I've actually handed the keys to some of these properties to potential equity partners and just said, here, take it for the weekend or take it for the week. And this has actually helped build relationships and scale quicker because, I can use this as an intangible benefit to provide to people who might want to invest in other properties with me and help me grow my portfolio. So that's my experience going from 40 long-term rental properties down to 19 Airbnbs. And I'm not saying long-term rental properties didn't work for me, but I'm just saying, the things that I was specifically looking for out of my investments, the Airbnbs just make far more sense for where I'm at today. So if you're sitting on savings or you're thinking about getting started in real estate, but you don't know what those first steps might look like, I'm actually helping people find good deals and walk them through the process of getting everything set up properly and helping them avoid those major mistakes that a lot of new investors are making. So if you want to see what it would look like to team up with us on your first deal and have us walk you through the entire process, I'd invite you to book a call down below. We'll talk through your goals, and if we think we can help you, we'll share with you exactly how we're helping new investors with their first deal and avoid all of the big mistakes. So book that call below. It's a free deal planning call, and we look forward to connecting with you.